So thank you very much, Yasmin. This is my first time at this conference, and putting it mildly, I'm blown away. Congratulations on very successful turnout and the wonderful things that you're doing. And I think all of us owe you a debt of gratitude. So my job today is going to tell you a little bit about what's going on in the venture capital industry in Israel. I'll try and do this in about 20, 25 minutes. Hopefully, maybe we'll have a few minutes available for questions if you've got any, and happy to address those. Can everybody hear me all right, by the way? Okay. So just 2 words about Vintage. We manage today about $1.5 billion. We started off as a secondary fund, buying positions in funds and companies in Israel. We expanded to being a fund of funds and then also to a late-stage co-investment group. We do that in Israel, Europe, and we're also very active on the fund of funds side in the US. And so over the years, we've gathered a ton of data. We see about 30 companies a week, primarily in Israel and Europe, and so it allows us to get a sense of really what's going on in the marketplace, how things are looking, et cetera. And I'm going to be presenting some data around some of the things that we've learned from that work. One of the things that we've done also, which is somewhat different, because we have an extensive database, we got approached a few years ago by a large U.S. corporate. It was after the Target thing happened when they stole the credit cards. And his CEO of this large corporate told him, like, you better make sure I don't get fired like that guy did. Came to Israel looking for cybersecurity technology, and we just basically mapped what we thought were interesting companies. So we now provide a free mapping service for large corporations, helping them look for technologies in Israel. We don't take any money on it. It's a way for us to add value to the ecosystem. Last year alone, we set up about 630 qualified lead meetings for startups with potential customers. Our portfolio is fairly broad, especially in the U.S. and Israel, and we're grateful to be invested in some outstanding funds. A number of them are represented here. And this is what I meant about the mapping. Actually, it was 670 meetings last year for 239 global 10,000 companies, and so if we can be helpful in any way, with pleasure. So let's talk about the Israeli venture community. I think this is a good statement of sort of the environment. There's a lot of money out there, and there's a lot of guys looking for the right strategy, haven't yet found it. But in an environment where there's this kind of money, how do you make money? And so let's talk about how the Israeli venture community has developed in the years. Sorry? Oh, wait a minute. Excuse me. Sorry about that. I forgot. Okay. So let me do this quickly. My mistake. Sorry. Excuse me. Yeah. So this is what I meant before. This is what I referred to in sort of some statistics about our coverage. And then here's some of the funds that we have the honor of being invested in the U.S., Europe, and in Israel. And this is what I meant about 670 companies we introduced for, sorry, I don't know why I skipped there, but 239 venture funds, for 239 global companies. Okay, venture industry. So let's get to the guts. This is what I meant. There's a ton of money out there. The business model seems to be, what do I do with that money? But now you got to earn something. And how do you make money in an environment where there is a ton of money out there? And so let's talk about what's happened in Israel, at least how the industry has developed. So, the Israeli industry started in 1992. I started my involvement in the industry in 1994, so I've been around in this industry a long, long time. There's a government program called Yozma, which many of you have heard about. It helped foster the formation of 10 venture funds. Some additional funds came in. Those funds then subsequently raised money, and there were about 39 funds managing about $500 million, or $1.5 billion, excuse me. Then the boom came 1999 to 2001. 85 funds raised, about $6.5 billion. And you're going to see what happened because of that. The industry is now consolidated down dramatically after that, the NASDAQ crash. Certainly the 2008 period also had an impact. And now we're back up to probably the best wave of fundraising by venture funds since the 1999 period. In the last 3 years, 41 funds raised, about a little bit over $4 billion. We anticipate that the wave that's starting now is going to be roughly the same, barring some financial challenges. Now, you can even see this tracked on an annual basis, right? So you can see the growth. 2010 was a terrible time for Israeli venture funds to raise capital, and certainly the last 3 years have been great. And we think that 2017 bottom up of who we know is in the market and who we think is going to close is going to finish off fairly well. Now, what's unique about the current wave and the previous wave is its composition. If you look at Israeli venture funds historically, they were very focused on early stage investing. What has changed is the development of a growth venture community. And in fact, a lot of the gain between wave 5 and wave 6 were the Israeli growth dedicated funds, Israeli-based growth dedicated funds that were formed. And so $1.2 billion was raised in the 5th wave for growth investing. And you'll see the implications of that in a minute. The other interesting thing that's going on is new company formation. Now, new company for us doesn't mean I've gone to register a company. It means that I've got some sort of money in, whether it's angel or something. We're now at a pace of about 1,400 new companies a year. That is about double what it was in the 1999-2000 period. So, lots and lots of new stuff coming out. Now, I'm not talking, that doesn't go to quality, but it certainly goes to quantity. And there's a lot of broader opportunity for investment than, frankly, there ever was. Now, so if you take what I showed you on these waves, right, and you take the total amount of money raised by the dedicated Israeli funds, and then you put the line is the aggregate number of new companies created each wave. The ratio of dollars to new companies being created is, one of the best we've ever seen in the Israeli industry from an investor perspective. So theoretically, you would think that would, push prices down, yield tremendous returns. What has happened is we've seen a huge increase in investment. So how does this jive where, a lot of companies being created, the Israeli funds have raised less than they did in the crisis of 2001, and yet, we're seeing a huge amount of increase in the investment in the total industry. Well, it's this. The portion of investment represented by Israeli dedicated funds is consistently going down. It's bumped up a little bit in the last year because of the fundraising I showed you, but for the most part, 85% of the money that's invested directly into Israeli-related companies is not by Israeli venture funds. It is by foreign funds, strategic corporate VCs, and by angels and incubators, which are becoming a much bigger factor, and we'll talk about it in a minute, and the implications. So, it's not like the Israelis have disappeared. In fact, our projection this year is it'll be about $650 million invested by Israeli venture funds, which is actually the highest, in a long, long time in the market, where you saw the big growth in the last number of years has come from non-Israeli VCs. So what's happened is these guys, who don't have to be invested in Israel, have found that Israel's a really attractive place to invest. A lot of the areas that Israel's strong in have come back and have become, hot again. And so you see growth in these investment from these people over the last year, and we think it's only going to increase. You even see this with some of the groups here putting offices on the ground. They may not have dedicated funds, but they have people on their team on the ground. Many have added to those teams. One has now got 3 full-time partners. Another one has 2. Another 2 have 2. And we anticipate that's just going to keep expanding over time. And we anticipate more leading top-tier international VCs will open up offices in Israel. Now, what the implication has also been is the number of deals that are led by non-Israeli VCs is also increasing. So it's not, at one point, it used to be that an Israeli fund would lead the deal and foreign VCs and strategics or corporate VCs would join. We're seeing a change. We're seeing fairly substantial increase in the number of deals led by foreign VCs and corporates. Now, we've seen a drop in 2017. Why? So let's talk about that. If you look historically at what foreign corporates in Israel have done and foreign VCs have done, it's been largely late stage. There's a reason that the amount of late stage capital invested in Israel since 2013 quadrupled, which is a gigantic increase, certainly in relative terms when you look at other markets, is because those foreign VCs and those foreign corporates have become much more active. Now, if you're sitting here in the Valley, it's pretty hard to do seed and early stage investment in a place that's very far away from you, so it's natural that you would tend to do growth deals, and that's what we're seeing. So I go back to why the drop, because prices, not surprisingly, have started to go up as a result. We track every round of every company in the country that raises capital. And what we've seen is a dramatic increase in C and D round prices. Now again, this is all average. Take it with a grain of salt. You know, some of these companies are more advanced, some of them are less advanced. Arguably, some of the companies have grown that would have been sold. All that, those criticisms are true. But I think there still is an indication that we are seeing a rise in late stage pricing. What's interesting is A-round pricing has been relatively flat. And so the early stage market in Israel has become particularly attractive on a relative basis. Now, so if I take a map of all the players in this market, you see a whole bunch of groups at the accelerator, incubator, angel base that a lot of them are new players. They've been around, not all of them have been around very long. There's a lot of stuff helping to feed with initial capital those 1,400 companies. A lot of players in what we call, quote, big local funds who used to do who are the A investors, a lot of players in that space have disappeared. So what's happened because of the pricing is we're starting to see the larger global funds who were late stage investors gradually moving down to become earlier stage investors, which is why we're seeing more and more funds putting people on the ground. Again, that enables them to do earlier stage investing. Similarly, we're seeing some of the micro and small funds moving up the chain. They typically may start off with a 20 or 30 or $40 million fund, then raise 75, then raise 100. When you're raising 100, it's very difficult in Israel to remain only a seed fund, and many of them switch to A's. So we think today that's a great place to be. We think it's going to get progressively more competitive, but it still is a great place to be. Certainly because of the number of new companies being created, so the deal flow is only going up. And sort of evidence of how that move is already taking place is this is showing market share of A rounds. The light color is the Israeli VCs. The dark gray is the US VCs. So you can see, you know, a greater portion of the market being taken for A rounds being taken by US VCs, which was my point before. And you see this active angel groups and the crowdfunders, you know, very active also in A rounds. Now, how sustainable that is, I don't know. On the bottom part, I mean. You know, having been in this industry for 25 years, every time there's a down cycle, the first people who, you know, ditch the market are private investors. And so we would anticipate that that is not going to be necessarily sustainable. And maybe, you know, we'll see less competition from those groups, you know, across the A investing. But again, I think the trend of foreign investors, corporates, et cetera, going earlier is a trend that's here to stay. Now, let's talk about sectors. You know, Israel still is, when you look at where the dollars are going, is largely a B2B market. The vast majority of money still continues to go to enterprise-related companies, business software. What's interesting is there's a very, I think, interesting, promising, yet to be proven, change that's going on in the medical space. Israel was never a biopharma market. I have a theory. You know, Intel's got R&D centers, IBM's got R&D centers, everybody's got R&D centers except Merck and Glaxo and others. And you know, those R&D centers have been very important to training people to, you know, to develop the skill set to build companies in areas. well, why aren't those big biopharma companies in Israel? Well, I think it's Teva. Because if the guys who are going to be stealing your drugs are also going to steal your people. And so Teva has actually been probably the biggest obstacle to the formation of a strong biopharma industry in the country. So if you look at medical, the medical space has largely been devices. Now the devices space is a tough space right now. Far fewer acquirers. FDA has been difficult on regulatory matters. So what we're seeing now is a very interesting shift in the medical space to digital health. And that is growing dramatically. And we've seen some very interesting companies. And so to the extent you're seeing the healthcare industry's money being, at least in staying in place or in certain cases increasing, it's because of the shift in digital health. So from dedicated medical funds, even the non-dedicated medical funds, in other words, the general IT funds, enterprise software funds, are getting into the digital health space, and they're keeping essentially the healthcare industry, for that matter, going. Now, what's interesting is, putting aside where the money is going, it's always interesting to see what the breakdown in new company formation is. We are seeing for the first time a huge increase in the number of consumer internet companies. Israel has never been known for being a consumer or consumer app market. We think that is starting to change. By the way, the fact that it's going down, don't read too much into that. There's always a delay of at least 2 years in new company formation data, because we usually get the data after somebody's invested in it, and it takes a bit of a time for these companies to get that initial capital. So we anticipate the number in, say, the consumer internet space will be sort of flat from 2015 on. But in absolute dollar terms, it is dramatic. And there's a reason. There's good companies coming out in the consumer space. Now, many of them, frankly, are Israelis who are starting their businesses here with their R&D in Israel. But even there are some companies that are headquartered in Israel who are doing very well, and we anticipate will be examples to others going forward to create consumer businesses. So we think this is going to be an increasingly growing area. One area that I think is going to be challenged, and this is going to be a controversial statement, is the whole cyberspace. We're tracking now about 600 active companies in the cyberspace in Israel. Frankly, we think there's going to be massive consolidation. The comments we're hearing from CIOs uniformly is, don't give me another application. We can't even deal with the stuff we're dealing with. Give me something that takes out 50 of the things we've got, or allows us to manage it more effectively. We anticipate very significant consolidation in the space. Despite that, last quarter was the biggest quarter ever of any subsector in Israel's history in raising capital. So a ton of money is coming into this sector. It'll be interesting to see what happens going forward. And we're a bit nervous about some of the stuff we're seeing and overfunding that we're seeing in that space. So what about the exit markets? Until about June, we were really worried. There was a 12-month period where the pace of VC-backed exits in Israel were actually the pace of 2008. People were not buying stuff. Now, we don't know why. We don't know if it's connected to the political uncertainty, particularly in the US, and you'll see this in a minute, but there's a ton of money, as you know, trapped outside the US that could be repatriated with tax reform. Maybe people are sitting on their hands to see what happens with that, because by definition, it's 30% cheaper, 30-some-odd% cheaper to buy a company in Israel than it is in the US, because when you repatriate the money, you have to pay tax on it. But there was a period where it was really quiet. The last quarter has been great in VC-backed M&A, and we know, and typically, historically, 40% of M&A in Israel has been fourth quarter. So it may turn out that 2017 is actually a good M&A year. And again, if you look at where the M&A activity is, historically, it's almost all been enterprise. And the one other area, and those of you who've heard me present in the past, a monkey throwing a dart on a wall gets a 3x on a semiconductor investment. in Israel. And go try and raise money for a semiconductor company, forget it. The assumption is that these companies are very expensive to run, very expensive to build, but the truth is, if you look at SaaS companies, you're financing your customers. So in the end of the day, our data is showing there's not a huge difference between how much money you end up investing in SaaS companies when you build them out and how much you're investing in semiconductors by the end of the day. The advantage of the SaaS, you certainly see, traction a lot earlier, but semi companies in Israel have done very well. And we think we'll continue to do well, especially in IoT areas. So while we're not seeing huge new company formation in the area, the good quality teams who do raise capital, we think are going to do well. And again, sensors for IoT are going to be, fundamental. This is the point I mentioned before. This is showing you what percentage of large U.S. corporations' capital is trapped outside the U.S. Look at the number for Apple, 96% of its cash. One of the groups here told me they're paying salaries in the U.S. with debt, even though they're sitting on lots of money, because it's cheaper for them to take debt to pay the salaries than to repatriate the money. What Trump will do on this tax reform could have an impact on M&A, certainly in Israel, but anywhere outside the U.S. And we'll be interested to see what happens if he gets tax reform through. IPO markets. The IPO markets have, as you know, in the U.S., theoretically were picked up in dollar terms because of the Snap public offering. But if you look at the actual number of companies, it hasn't been great. I mean, when I started my career in Israel with Robertson Stephens, which was a U.S. investment bank, there were 350 to 500 IPOs a year. Well, those days are gone. But like in Israel, the fact that it's gone down, it's been since Q1 2015, we haven't seen an IPO out of Israel on a U.S. exchange. There are a few that are about to go over the next 6 to 9 months, and there's a bunch of companies which we think are pretty attractive that hopefully will go over the next 3 to 4 years. So people are building big companies that could go to IPO, but let's see, the proof's in the pudding. Some stuff about founders, and I'm going to wrap it up. One of the things we decided we try to do, you probably can see we're kind of data freaks, is we looked at what works, what doesn't work in Israel. So we looked at every single exit from 2008 and asked who managed the company at the time of exit. And what you see is on anything that was exit of $150 million and above, 71% of the companies were managed by founders. And the cases where an external CEO was recruited, the majority of those cases was an Israeli. It has yet to work effectively bringing U.S. management on top of Israelis. I don't know if it's a cultural thing, I don't know what, but it hasn't worked. It's even more evident when you look at the bigger exits. 78% of the companies which were sold or went public at a valuation over 500 million were managed by Israelis, Israeli founders. So as investors, the message clearly is if you don't believe in the founder, don't invest in the company. Because founders have to be able to scale with Israeli businesses. The other thing that we looked at is where was the head office. So it may be a founder's got to run it, but in large case, he's got to run it from here. He or she has to run it from here. You have to be close to the market. It's very difficult, especially the enterprise space, to build significant companies out of Israel. And the data, clearly shows that founders have to be based here. This is my embarrassment slide. We looked at how many of the companies that were sold had women as co-founders. 3%. This is a huge problem in Israel, and I think it's a huge problem here. But I think it is something that's got to be addressed. I'm happy to answer questions if you want about this. We're trying to lead a big diversity initiative in Israel to help facilitate this, but there's no excuse for this, and we think that's got to fundamentally change. One good piece of information, one good piece of data, is the percentage of people from the Arab community who are now going to study technology. It's about 3 to 4 times where it was only a few years back. The bad news is not everyone, and certainly not their proportionate number of graduates, are participating in industry. Many of them end up going into education or doing something else because they're not finding jobs. And so one of the things that I think we as an industry have to do is a much better job at making our workforces, our entrepreneurial base more diverse. It is certainly in the interest of the industry, but more importantly, it's the interest of the country. So if I summarize, a lot of good companies are being created, great news. There's a lot of money running after them. I think, we think today the biggest opportunity is in the mid-stage, or rather early stage, because there's a lot less money running after deals, and the new company formation is very strong. But as I said, IPO activity has been weak. We need to see Israeli companies start going IPO, and not IPO as an exit, IPO as a financing event, and more importantly, start acquiring other companies. One thing of research we did is we looked at, over a 10-year period, Israeli companies went public versus US companies went public, and the number of acquisitions they made. A US company had 6 times the more likelihood they would make an acquisition than an Israeli company. There's a tendency to think that we've got the solution to everything and we don't make acquisitions. That has a very, very negative effect on the product pipeline and cycle. And so building out companies requires thinking much broader, defining the category much broader. So we're cautiously optimistic. There's some great companies in the pipeline that could go IPO, but hopefully when they do go IPO, they're going to use that capital to build out their businesses to where they should. And finally, and this is the thing that all of us have to work on, we have to make this industry far more diverse. It will be a far better industry. Instead of only Shmonamatayim guys, developing software that only Shmonamatayim guys can understand, we need people who are doing things that really can solve issues for international markets. So I thank you very much, and I'm open to questions.